If you clicked this video because you want to know what really happened to silver, why it crashed so violently, and whether this move is the beginning of the end or the setup for a historic moonshot to $150 and beyond, then you're exactly where you need to be. Because what you're about to hear is not the watered-down version the financial media keeps repeating. This is the version that actually explains the chaos, the panic, and the trap that just snapped shut on millions of investors. And if you understand what really happened here, you'll understand why this so-called crash may end up being remembered as the greatest buying opportunity of the decade. Silver just suffered one of the most brutal sell-offs in modern market history. And I'm not talking about a normal pullback. I'm not talking about a healthy correction or a routine dip. I'm talking about silver getting slammed down by nearly $30 in a single trading session. $30 in one day. That isn't the market cooling off. That isn't investors taking profits. That is a liquidation event of historic proportions. The kind of move that doesn't happen unless something breaks behind the scenes. And immediately, right on schedule, the media machine kicked into full gear. Headlines flooded the financial world. Silver was overheated. Silver was a bubble. Silver was done. They told everyone the run was over. They told investors to sell, to exit, to cut losses before things got worse. They rolled out the usual parade of analysts, talking heads, and financial commentators, all delivering the same message in different packaging. This was the end. But here's what they didn't tell you. Here's what they didn't want you to see. While the Western world was panicking, while retail investors were dumping positions in fear, something completely different was happening on the other side of the globe. While Americans were getting shaken out, while Europeans were staring at charts and smashing the sell button, the real silver buyers were doing the exact opposite. In Asia, silver wasn't crashing, silver was being hunted. In Singapore, in Hong Kong, in China, physical silver buyers weren't running away, they were rushing in, aggressively, desperately, like they knew something the West didn't, like they understood the paper price wasn't real and what was happening on the chart was nothing but staged performance. While COMEX looked like it was falling off a cliff, physical dealers were seeing the opposite reality. Not quiet shops, not empty phone lines. They were seeing crowds, lines out the door, people buying everything they could get their hands on. And these weren't casual buyers picking up a few coins for fun. These were serious purchases, monster boxes, 1,000-ounce bars, bulk orders, real accumulation. Dealers were getting hammered with requests they couldn't fulfill fast enough. Inventory was disappearing in real time. They were calling suppliers, begging for shipments, scrambling to find metal because demand wasn't slowing down, it was accelerating. And here's the part that should make you stop and think. These buyers didn't care that the paper price dropped. They didn't care what the chart looked like. They didn't care what CNBC said. They didn't care what Wall Street analysts were declaring. They cared about one thing: getting physical silver into their possession. And they were paying premiums that should not exist in a real crash. $8 over spot, $10 over spot, $12 over spot, sometimes even higher. So ask yourself the simplest question imaginable. If silver truly crashed, if the fundamentals broke, if the bull market ended, then why were buyers in Asia lining up to pay massive premiums? Why were they emptying dealers' shelves? Why were they draining vaults? Because they understand something Western investors keep forgetting. They know the paper market is not the real market. They know COMEX is paper theater. They know the spot price is a number created by contracts traded back and forth by institutions that never intend to touch a single ounce of metal. They know paper can collapse while the real market tightens like a noose. And that is exactly what happened. What we just witnessed wasn't silver collapsing. What we witnessed was the paper illusion collapsing while physical silver screamed shortage behind the curtain. And now we get into the evidence. Because this isn't just a dramatic story. This isn't a theory built on vibes. There are clear signs that something broke. Start with JM Bullion, one of the biggest precious metals dealers in the United States. During the chaos, during the panic, during the most dramatic silver move in years, their website went down, completely offline, for hours. Now let's be clear, JM Bullion doesn't just casually go down. They have infrastructure designed to handle traffic spikes, backup systems, redundant networks. They are built for moments exactly like this. So why did it crash? The official line was technical difficulties. Of course it was. That's always the excuse. But the whispers from people watching closely were different. People weren't saying it was just traffic. They were saying something much more serious. They couldn't source enough metal. They couldn't guarantee inventory. They couldn't keep up with demand. They couldn't fulfill what buyers were trying to purchase. And when that happens, taking the site offline becomes the easiest way to stop the flood. And it wasn't just JM Bullion. Reports started circulating about disruptions connected to the LBMA, the London Bullion Association. And you need to understand what that means. LBMA isn't a small player. It's the beating heart of the global physical precious metals market. That's where the big institutions operate. That's where the vault system lives. That's where delivery logistics matter. And during this crash, there were persistent reports, unconfirmed but loud, that transactions were delayed, deliveries were pushed back, and things were not moving smoothly. Of course, LBMA denied it. They always deny it. Major institutions never admit weakness until they're forced to. They don't announce problems early. They bury them, they patch them, they hide them until the truth becomes unavoidable. But even the hint of disruption at that level should set off alarms in your head. Because in a real crash, physical dealers should be swimming in supply. People should be dumping metal. Inventory should be piling up. Premiums should collapse. Websites should run smoothly because there's no shortage. There's too much metal available. But that's not what happened. Instead, dealers got overwhelmed. Websites went down. Premiums surged. Inventory vanished. That is not what a real crash looks like. That is what a system under stress looks like. And the reason this matters is because the entire silver market is built on one fragile illusion, that the paper price reflects the real world price. But it doesn't. The paper market is a derivatives casino. Contracts are traded, leveraged, flipped, dumped, and settled in cash. Most participants don't want silver. They want exposure. They want bets. COMEX is not a place where the average contract holder expects a truck to arrive with metal. COMEX is a paper machine. And that paper machine just staged a crash. But the physical market didn't follow. In the real world, where people buy coins and bars, premiums went insane, not down, up. American silver eagles were selling at premiums that bordered on absurd, $15 over spot, $18 over spot, sometimes even higher. And people were still buying. That should tell you everything you need to know. Because premiums are the lie detector. If silver truly collapses, premiums collapse too. Dealers lower prices to move excess inventory. They offer discounts. They compete for customers. They slash margins to clear shelves. But when premiums rise during a paper crash, it means one thing: physical supply is disappearing. It means the number on the screen is not the real price of silver. And that leads us into the numbers, because this is where the story becomes unavoidable. Industry analysts are projecting that by 2026, the global silver market could face a deficit of around 590,000 tons. Let's translate that. That is roughly 19 billion ounces. 19 billion ounces of deficit. And here's why that number is insane. Global silver production is around 1 billion ounces a year. That means this deficit isn't a small gap. It's not something mining can catch up with. It's not something solved by opening a few new projects. That kind of deficit is catastrophic. That kind of deficit can only be met by draining above-ground inventories. And those inventories are already being drained. So where is all this demand coming from? Industrial demand, the part of the silver story most people still underestimate. Silver is not just a shiny metal for investors, it's a critical industrial resource. Solar panels require it, electronics require it, batteries require it, EVs require it, medical technology uses it, communications infrastructure uses it, defense systems depend on it. Silver is the most conductive metal on Earth, one of the most reflective, and its antibacterial properties make it irreplaceable in medical applications. It's not optional. And as the world electrifies, as solar adoption accelerates, as EV production ramps up, silver demand isn't rising slowly, it's exploding. Meanwhile, supply is not. New mines take years to build, existing mines are aging, ore grades are declining, and most silver isn't even mined as a primary metal, it's mined as a byproduct of copper, zinc, and lead. Which means silver output is changed to the economics of other metals. You can't just flip a switch and flood the market with silver.
So you have demand accelerating and supply stuck. That's a formula for a violent price event. But industrial demand isn't even the full story, because investment demand is rising too. Not just from retail buyers stacking coins, not just from collectors, not just from people buying a few bars. The smart money is moving. Central banks, sovereign wealth funds, and major institutions have been accumulating hard assets. And while the mainstream media loves talking about gold, silver has been creeping into the picture quietly, discreetly, without announcements, without press conferences. Because silver is money. Silver has been money for thousands of years. It's not just another commodity like copper, it's monetary metal that also happens to be industrially essential. And that combination makes it uniquely dangerous for the current financial system. Because when confidence in fiat currencies collapses, gold rises first and silver explodes later. And the moment silver becomes mainstream again,
at the same time, COMEX registered inventory, the metal officially available for delivery, is collapsing. That number has been bleeding lower month after month, and we're approaching levels that should terrify anyone paying attention. Because if too many contract holders demand delivery, COMEX does not have enough silver. And that's when the game ends. That's when paper and physical decouple. That's when silver becomes impossible to price. Now here's the final truth. The system is breaking. The paper-silver market is losing credibility. The physical shortage is intensifying. The disconnect is widening, and the people running the system know it. They are desperate to keep control. They will keep shaking the market, staging drops, manufacturing fear, and trying to steal physical metal from the public before the real repricing happens. But they are losing, because the math doesn't lie. Supply cannot meet demand. Inventories cannot last forever. Eventually, reality wins. Eventually, the paper market fails. And when it does, silver will not move politely. It will explode. It will leap to $150. It will push toward $200. It will go to levels that sound ridiculous today, but will seem obvious in hindsight. And that's why this was the $90 trap. That crash was the final shakeout, the final test, the last attempt to scare the public into handing over silver before the moonshot begins. If you held, you passed the test. You were positioned for the trade of a lifetime. And if you sold, you still have a chance. But the clock is ticking. The window is closing. So make your decision. Act now or watch history happen without you. Because the moonshot is coming, and you're either going to be part of it or you're going to sit on the sidelines staring at the screen, wondering how you ever let them scare you out of the opportunity of a lifetime.